Joining us on the phone line right now, Amnish Agarwal. Amnish, hi, morning. It's not just Britannia, not just Dabur, but now the giant Unilever as well, wherein the profits and margins have left much to be desired. What is it that you're making of the numbers, and by how much could the stock now be pegged back? Are you going back to the drawing board, revising your price targets on Unilever?
You see, as far as the volume growth is concerned, most of the companies which have reported numbers so far, they have seen some moderation in the volume growth, which is primarily led by the slowdown in the rural demand. If you can recall, a couple of quarters back, rural was growing at, say, roughly around 30 to 50% higher. If, say, your urban was 1x, then rural was 1.3 to 1.5, and now which is more like 1.1. So there is very little gap now. So it's mainly the slowdown in the rural demand which has led to the volume growth for some of these companies disappointing. Now, as far as liver is concerned, in addition to the volume growth, I think the management commentary, whether it was margin expansion or tax rate, so that also had an impact. So consequently, we have cut our estimates by roughly around 4.5% kind of a number, and we have also cut our target price from 1854 to 1764. As far as the stock price is concerned, we are valuing it at 46 times FY21. So if you look at the past 20 odd years, most of these names we are trading at lifetime high P multiples. So we don't think that there is going to be a straightforward re-rating or scope of any big rally from here on, and the returns will only come over a period of time.
Anish, if I really look at the basic tone of the commentary from HUL or from Britannia, they are hinting at a further slowdown in the rural category. Markets are working with an assumption that MSP has gone higher, government is giving money in hands of farmer, that money, that $8-9 billion which was promised in the budget has already reached in the hands of the farmer, yet it is not having an impact on the rural demand per se. And this year we already know that there is a drought-like situation in various parts of India. So is it safe to assume that rural-focused FMCG companies will continue to underperform and one should actually avoid buying them completely?
You see, as far as your rural growth is concerned, like for example, last year's monsoon was patchy. Then the prices of some of even the cash crops, they were on the low side. Okay, so whatever dent was to happen as far as the farmer's income is concerned, that has already happened, and that is reflected in some sort of a slowdown in rural demand. Secondly, people are expecting a lot of pump up in the economy to happen ahead of elections, which might be a reason that last year, particularly in the first 6 months, the demand was very good. Now, as far as the current situation is concerned, I think a lot depends upon, first of all, how the monsoon goes. As far as your crop prices are concerned, I think it is not going to, you can say it's very difficult to predict actually how they go. And as far as the PM Kisan Yojna is concerned, the farmers were to get money in 3 installments of 2,000 each. So in some states, the money has reached, but a lot of states, they have not yet collated the data, so even that money has not reached the farmers. Because our view is that this 6,000 rupees per annum actually takes care of, you can say, some of the expenses or the cash expenses which they incur on sowing of the crops and all that stuff. So which could, if it provides any prop up to the consumption, it would be staples. So I think it would be only in the, say, next quarter or so that the clarity will emerge how the monsoon goes and how the entire sentiment plays out.
All right. Appreciate your time, Anish, and thank you for your thoughts.